Hi guys, I trust you are all well and we're ready to have some fun in today's session. Just going to share my screen very quickly. Trying to find my glasses. Share my screen with you. Okay. That's interesting. I'm not sure. Let's try again. Okay. All right. Sorry about that. I'm not sure why we are struggling, but we are on. All right, guys. What I want to share with us today, or rather just to kind of present to you, the way I trade with price action. And it's really, if you want to trade price action, you need the discipline, the patience of looking at each bar as each bar unfolds. So bar by bar price action. Yeah, I'm well, buddy Richard, trust you all too. But bar by bar is quite a difficult process, especially when you trade in a lot of markets like we are trading 7 here. So the way to get into it is to think of pattern counting. Now, it's just a term that I have made up. For those who are studying how to trade price action, probably won't hear that from anyone else, but it makes sense when you think about it. So earlier on this morning, I was up at 3:15. Well, I was in the market at 3:15 my time, which is daylight saving zone. I think it's 1:15 GMT, so 2:15 UK time. Looking to trade the open of the Hong Kong Stock Exchange and trading the Hang Seng 50. Now, I define the open as the first two hours, plus or minus 2 hours of any session. So presently, we're just out of the open in terms of how I define of the UK, the London session. All it means is that I shift my mindset in terms of trading changes when I'm out of the open and the market is still unfolding. During the open, during those first couple of hours, which could be the first 18 to 24 candles or bars on the 5-minute time frame, I'm basically looking for 3 types of patterns. So one, based, of course, we always start by looking at what happened yesterday, where we are on the daily, and etc. So I'm looking for either a trend that starts from the open. So if the setup on the daily is for a bull trend, I'm looking to see if I can catch a bull trend that begins at the open, begins, within the first 6 candles of the open, bull or bear. That's one set of patterns that I'm looking for. I'm also looking for reversals on the open. That's when the market tries to do something up, tries to break to the top and fails. I'll look for a setup that allows me to trade, going down, or if the market is going down bearish and it fails, I need to look for those reversals and try and trade the market up and catch some profits in that particular time period. So that's one. So the trend from the open or reversals, attempt to go up, fail, attempt to go down, fail, and then let's take the trade. Then the other thing I'm looking for is breakout mode. And breakout mode is a trading range of sorts that forms in that particular open, because that can inform where the market is likely to go beyond the open. Now, breakout mode trading range is another whole different ballgame, because trading range can be tight trading ranges, it can be broad trading ranges, it can be triangles, all sorts of things. But and you get to grasp this as you work through it. But in terms of counting patterns. Now, these are things that we've spoken about. I just haven't put the number counting on our charts before. But let me take you through it. So the usual stuff that we do quite happily. High of yesterday, low of yesterday, you use your Fibonacci to find the midpoint of the day, 50% of yesterday's range. So you just plug it within there. Key levels, market might try to break out. You know, that's the level of resistance, or market might try to break out below. That's the level of support. Midpoint, 50% is a magnet in any trading range. And yesterday's range, top to bottom, is a trading range. So 50% is key because that's a magnet that might pull the market down. Another level that I had, it's the low of February 2022. Very important to have that at the present moment because, of course, last couple of days of the month, if that's the low of February, then it's a huge level of resistance. You know, for the bulls, if they try and break out above that, for the bears, they just want to sell and let at least this month remain a bearish month in spite of the tail that we have on the monthly. But let's not get distracted on that. So on the open, so I'm gonna take just a few seconds to describe what happened here and the trade that I took. Then I'll just walk through a little bit quicker on the other charts and try and get through those before we end our session. Again, if you've got any questions, comments, just pop them into the chat box. So there was the opening candle, and immediately when I see the range of the opening candle, whether we have a gap down, and many times on the Hang Seng 50, we have a gap down on the open or a gap up. I try and, when I see a candle that's larger than the previous candle, just look to the left. That's already a range that's been created on the open. If it creates a tail, in my mind, I'm saying, okay, that is a trading range of sorts. So whenever I see a trading range, I want to see the potential measured move of that, of any breakout above that range. So you could always, at the open, put your measured move to say if it breaks to the top, excuse me guys, how far will it go? So before you see anything else, you could also just say if it breaks to the bottom, how far would the bears likely want to go? So that you can do right when you see that huge candle, breakout, breakdown, whatever it may be on the open, okay? Or you can just wait like I did. So I saw that, I said, fantastic. Let me see who's going to try and control the market. I saw an inside bull candle and follow through by the bulls. Then I said, okay, likely the bulls want to break out above that. And if they do, what is their goal? And the goal would be a measured move. Gonna drink a lot of coffee. Price action traders, 5 minutes, staying long in the market. Coffee and water, coffee and the water. Keep the mix going well. So follow through candle, failed breakout above the open of the day. At that point, I'm kind of thinking, well, let's see, if the bears are going to try and now take over the market and break beneath. They failed. They had a good attempt. They failed to do that, and market reversed. The moment I see that, I have a high, I have a low, I have a double bottom, higher low. So I just go and put, that's the first low that I'm going to watch. So just put a 1 on it. Okay, there's not much that you got to really wonder about how this pattern counting comes. Just remember everything we've spoken about. You see a particular low or high, you want to see what happens after that. Then you want to see the second and the third, third price action unfolding and decide how to take your trade. So that for me became, just at that point, that became a key higher low, the low of the day, key higher low. So it's a double bottom, but because it's all within all of this low and this higher low double bottom is all within that that George magical number of six candles. I'm always looking for 6 candles of separation between price levels, because that stops me from jumping into the market before price is fully formed to give me a fair picture. So just keep that in mind, 6 candles of separation. Okay. Why 6 candles of separation? Why that term? Well, as a private pilot, one of the things that the control tower does to then need to keep different flights coming in at different levels, just to stop mid-air collisions, and that's that's irrational. That's all they used to it. I just realized after being stopped out so many times and stepping out of the market, then just goes your way, saying, on, what am I missing? And the more I analyzed, I realized, if I allowed 6 candles of separation, and that's the number that I look at. And if I don't see it, I hesitate. If I see 5, if I see 7, and I'm comfortable with it, okay, I just count it in. So kind of separating price levels one from the other to allow me to take a trade. Then, we had a resumption, break above that high, of course, break above the open, and a test of the measured move. So there is a hidden level of resistance. Measured moves are hidden levels of resistance. If the bulls were strong, they would have given us a close above the measured move. Then we would have said, fantastic, the bulls are strong, breaking out of a trading range, broken out, we've had follow through. Let's see if they can break above this key level of resistance, which is a high of yesterday. If they'd done that, we would say, yippee, forget about the bears. Let's wait for a pullback and let's wait to trade the pullback. So, excuse me. But that did not occur. We had perfect reversal at a hidden level of resistance. Fantastic. Now we have a top. Fail break above resistance. That for me, a market is number 1. Okay, after this candle is closed, that is a key level, key high of the day. At this point in time, that's a key high of the day. And I'm saying, fantastic. All I need is to see that particular level being confirmed by another lower high or double top. It could have been high. It doesn't matter which way it formed, but anything that's failing at that level, within my 6 candles of separation, 2, 4, 6. So within that 6 candles of separation, but instead, what we had was a lower high. Another attempt by the bulls at some point, full bull candle, could not get to that high, could not get to that high, tend. Now we had this a second level, and I'm saying, happiness, this is good. All I need now is my signal at the 3rd level. Remember, always saying, when you see a double top or double bottom, big tick, there is a pattern. You need a higher low. You need a third signal to get into the trade, whether it's a higher low, or it's also a perfect double bottom, or it's a lower low, whatever it may be. If you see a double top, happiness, but you don't execute on the double top, we need confirmation that the forces that have created the double top have taken control of the market to our 6 candles of separation, lower high, boom, then we get it. So at that point, on my pieces of paper, which I have thrown away, this I was talking to some guys that I coach, and this is quite interesting. I'm just gonna show you quickly, old school. Let's assume I was selling. I'll show you in a moment. You need to do this. No matter how computer savvy you are, you need to have these little pieces of paper. So hopefully that kind of makes sense. So that's Hang Seng 50. So I just scribble this on a piece of paper when I'm about to execute a trade. If I'm selling, that's where I'll write my stop. So I'll just put numbers there. So I would literally go into my charts. And in this particular case, what I had was my stop would be, of course, above the nearest technical level, which is yesterday's high. So I had the number there. The entry point, I was waiting to say if I get an entry point somewhere within here, after the two, a lower high, double top, etc., I would have put it in there. Then, of course, my take profit. So you just gotta write the things down because it's easy to get confused, and also gives you structure. When it's done, if it's triggered or not triggered, you throw it away, get another piece of paper. So here I was, had my stop level predetermined, knew where I'd put my stop, and what I was waiting for is the market resuming back. It's got to come back into this level, give me a double top, give me a lower high, whatever the case may be. That would have given me my entry price. $10 on the Hang Seng 50 be below the price, with my stop, quickly work it out on my calculator and work out how many units I should buy. And what I prefer to do, if it had done that, that's my take profit level. Go into there. I prefer to manage my trades. I prefer to sit and watch. Sit and watch and be able to manage it. The reason I do that is that I might get acceleration, we might get pullback. I might have pulled my trade to break even. I can execute another trade if that had happened. But as it was, we did not get that trade. So I was like, okay, all right, let's wait. And I'm flipping through. The only other market I'm looking at that early in the morning is UK 100. Because they're within an hour of opening of each other. I'm trading the open. The market has moved beyond the 2 hours on the Euro, S&P 500. So in that early morning state for me, I only want to look at the open. Why do I trade after the open? In between sessions after the open, I'm now looking for trends, just trends and pullbacks, trend pullbacks. I'm not looking at reversals until I get to the next session. In any case, I didn't see that. I leave it there, and then we wait and wait. Let's see what happens. Okay, we had. Let's talk about this first before I get to talk about that. So the market, instead of coming back, went down, and right at that level where I had my first low or higher low, tested that and turned, and then went up, had follow through. That became for me a second key level. Now, talking about looking for reversals, already I remember I said I'm looking for the opening reversals. Market tried to go up twice, failed. Tried to go down twice, so that's because of the candle of separation is all one, failed. So I'm in that mode where the next price action that triggers on either side of those levels, I'm going to look for an opportunity to jump into the trade. It's one of the reversal trades. Okay, opening reversals is one of the key patterns at the open. So when we got now, so all of this hasn't happened. We get this, got our two levels there, got our two levels at the bottom. We get a decent enough reversal. What do? Okay, some guys who scalp could jump in that and say, I'm just going to scalp and see if we get enough acceleration and take quick profits. I do not do that. This is the middle of the 4-minute trading range. I'm looking to take a trade up here. Okay, so when this kind of bounced off here, even you got that reversal, so now let's see if we get market trying to accelerate. We might get a two-legged move, leg one, pull back leg two, that brings up into that zone, in which case we can look to take our trades and go short. We did not get that. We had the bears kicking in, which is not a problem, because if the bears are strong, they need to break beneath this level. They need to break beneath the low of the day. And then they need to break beneath this key level that's pulling the market down, the 50% pullback, need to break beneath that and follow through. Then we know the bears are strong, then you can wait for pullbacks. But now here's what's key about pattern counting. Remember, so your mindset is looking for these opening reversals because you are in the opening, trying to find the opportunity to jump in and grab some profits out of the market. So when I saw that, I did not change my mind to bearish at all. Okay, you wait and see what you get. Then you get this is as near perfect as a get. So attempt to get to the 50%. So it's a test of the 50%. Failed breakout beneath the low of the day, beneath the double bottom because of the reversal. Then when you see that, just close your eyes and take the trade because you have a wedge pattern. First push, second push, third push. Failed breakout beneath the low of the day. Test of the 50%, the magnet, 50% resistance range. Decent enough inside candle on the reversal candle. Trade to take above there and put your stop. So where do you take your profit? This is where it gets interesting because you haven't seen all of this stuff and you're trading the open. I think somewhere, let me just see. Yeah, in here, the market closed for an hour. Okay, so the Hong Kong Stock Exchange closed for an hour, which is 6 o'clock my time, which is midday Singapore time. They close for an hour. So whatever happens, I'm getting out of the market before that. The only reason is that that's when my other life starts. Kids at school, go do some exercise, get yourself ready, breakfast, etc. So I take my profits. Where would you best take your profits? Where is my line chart? Okay, there's a line chart. So you're taking a trade here. This is based on closes. So you're taking a trade here. You can aim for that lower high based on closes, or you can aim for that. If you're setting your profits and going away. If you trade managing, you hang in there and you trade manage. So I took the trade here and the stop just beneath here. And then, you just wait for acceleration and see how far you go. So at this point, after I saw that, I kind of said, oh, that's a bit of a disappointment. If the bulls were strong, they should give us, they can allow a pullback, but don't break above that candle. Have a decent pullback, test moving average, and get acceleration. So that was a big indicator that the market is not going to go high. So when I got that price action, something, because I'm trade managing, I got 5 candles to go to the end of the day. I got to decide when to take out something that you can do when you have the experience. You just switch over to the 1 minute time frame and look for the patterns there. I saw a reversal somewhere within here, and I manually closed my trade. I could have put my take profit on that close, like I'd mentioned before. So within this zone, I'm looking to take profits. If I'd seen acceleration, I would have waited. So that was a fair enough reward for the day. Of course, you come back after doing your stuff and you see all of this like, oh, okay, who cares? All right, guys. So now that's the point is pattern counting. Okay. When I was learning price action, one of the things I did, I remember talking to Paul in one of the sessions we had, way back, one of the sessions in Singapore, the boot camps, and showing him. I literally would be sitting and say, bar one, inside candle, follow through, tail, test of the, over and over and over again to get to understand the story that's unfolding before me. Now, I don't do that anymore, but pattern counting is continuous. Every time we've spoken, I said, okay, there's a double bottom, look for. It's just that when I was thinking about it, I think it makes it clearer for the guys who are following, the live trading profits to understand the thinking processes that I'm going through. Now, here's what's interesting. So when you get here, I think I came to the market, I don't know, somewhere around here. But then when you get here, there is a clear high that is significant. We broke out above the previous high of the day, closed above the yesterday's high, and the bulls were strong, of course, followed through, failed. That bear candle gives, that's a key level. 6 candles of separation, that's a key level. So seeing this, and I said, okay, and I saw that, I said, brilliant. Okay, let's get ready. Piece of paper, stop would be above this key level. So that's a key level, low of February. What I was waiting for is after this candle, or that candle, a pullback, give me a third level, it could be like that, it could have gone higher or whatever, then we'd have sold. But we did not get that, and we market accelerated down, pulled back to this level. Now, this level is a 50% level of this little trading range. Okay, I put that level in after I'd seen that low here, but you could have drawn it if you wanted up there. It really doesn't matter. This is a trading range that's formed. We do not take trades in the middle of the trading range. This would be a perfect signal if it's after the open. If there's a bear trend, then there's a pullback that's materialized in front of us, and we get a pullback to the 10 EMA. That you just close your eyes, boom, and you take the trade. These are the trades that you teach, that I say, like I teach my 11-year-old daughter and say, listen, if you see this kind of thing, just press here. I mean, she doesn't actually do it, but I'm saying this when you see some of these things, you have to just take the trade. Like when you see that, and if it falls before you, perfect, just take the trade. In any case, so nothing much happening here. What I'm looking for so far, that's a key higher low. There is a double bottom, that's a key level. Now, what I'm looking for presently, my mindset at the moment is, if the market gets up here and gives me a lower high of whatever of sorts there, okay, at that level. And again, remember, one of the days we spoke about, if you're going to take that kind of short, you cannot ignore preceding price action. So if we see the market has gone up, it's come back, it's gone up, it's come back, and it's gone up, and it gives us a lower high, then this is where, again, we are happy days. Why? Because we would have had a wedge pattern forming. Okay, so if we saw that, now we're assuming it does this. If it doesn't do this, we'll just read what it's done, and then we decide which way to take trades. Okay, and let's say it does that, breaks above that point, and pulls back. However long it may take to form, it might, take its time to form. I think 2 hours from now, or 2.25, there is non-farm payroll, that ADP one. It might take up to there. It might take up to the open of the US session, which will be brilliant, because then we look for opening reversals in that session. But if we get a lower high here, I'll be very happy, not just because it's a lower high, but because also market is trying to go up once, tried to go up second time, third time, wedge, failed. One of the other things that we take, lower high, and then we take the trade. So my bias is too short, but I need to see what's happening. What would be exciting is if we do get the short, this measured move here of this trading range would take us all the way down here. So it should be worthwhile to wait. If you're in the market, take a trade. And if you do see the setup, if you're able to watch the market, don't set your take profit here, which is perfect to do that. Just wait and see and sit through any pullback, and hopefully you might get acceleration. Okay, so let's just whip through. Okay, UK 100 was something else that I was looking at. So while I was looking at the Hang Seng 50, I was keeping my eye on what is happening here. The market is already opened, I think an hour or so, a couple of hours before I came in. So at that point, I'm no longer looking for within as long as the 24 candles, 2 hours is gone, then forget about trying to find reversals. Wait to see if you get a trend. Now, isn't that fascinating? I don't know what someone has said, whatever, who cares? Price action. So we've had this sudden collapse to test that level. And it's only the first 25 seconds. So it'll be interesting to see where that ends. If the bears are strong, well, we expect a close on or near the low. And then we would expect follow through. And if they're not, now, hopefully we'll look at it later. But if it closes up here, for example, that becomes, I just put number 2 there, okay? So there was that low that was slightly higher, high, double bottom. So if it closes somewhere above here, that becomes a key level. I just want to see the next 6 candles of separation. And if the market comes back, we're assuming it closes up here. Who knows? It's still first minute. But if it closes up here and does 6 candles and comes back and gives me a high, low, and decent enough candle, boom, I am going to take it. But it's a trading range, guys. You can't ignore the trading range. So you don't want to execute anything in the middle of the trading range, which means either we're down here or you wait for the market to get up here. If it gets up here and whatever happens, if it turns at the open of the day. Okay, remember, we've got to check this when the price action gets here. But assume it does something like that, somewhere up here. So now you have a perfect double top at the level of resistance, which is open of the day. You just want to wait for a lower high, or you might get a higher low and a perfect enough reversal. You take the trade. Okay, and you're taking the trade back into the trading range. If you can manage it and see what happens. Euro. Okay, so I've put the euro on the 15 minutes, and I think I explained it. I hope I'm still on. I just said my bang going, but I presume I'm still on. So I put the euro on the 15th because I'm not watching it. Okay, I was watching at that stage UK Hang Seng, and I also had just chatting. Okay, super. Thanks for the feedback, Richard. Appreciate it. Okay, so if nothing else is happening and this looks like setting up 1, 2, you just put it back on the 5-minute time frame. The levels are still valid. Okay, that's a key level. Test of yesterday's high. There is another key level. So it's like 1, 2, 3, which is fantastic. Now, all we want to see, if the bears are strong and they're creating this, whether we have a tail or not, let's see if they will be able to defend the bulls trying to resume the buying, because bulls are seeing all of this. And if the bulls try to resume the buying to get the close above yesterday's high, and we get a decent enough reversal, you've got to take a trade and put your stop just above there. Okay. UK 100, Nikkei 225. Let's just have a quick look at this. Again, so I'm just going to leave them on the 15, and again, understand, because when I'm not focusing on it, I just stick it on there. The reason I've done that is that I've found that when I'm moving from 5 minute to whatever, if I'm taking the Hang Seng 50 trade, for example, I get so absorbed setting it up. By the time you flip back, it's like, well, what's happened? I don't have enough my cranial computer is not fast enough to process things. But I also want to keep track of the market. So if I'm doing something, if I just flip it over to the 15 and it's up there, there's nothing to worry about. But if this price was down here, and I'm saying, hang on a second, that is a beautiful setup, then you've got to go to your trading time frame and have a look at what's happening, because then you get a double bottom, higher low, or lower low reversal. Boom, take it up. Okay, S&P 500. Again, so did I explain that, or am I just rushing myself? Okay, so there's a key level. Now, here's what's important. Good bear breakout beneath. So this is strong bear price section, closing beneath a key level, which is the low of yesterday. And the bears should have given us follow through, but we went sideways, created a small trading range, which is great. But every time you see a trading range, you've got to ask yourself the measured move. What happens if we get the breakout beneath that? How far are we going to go? And I'm hoping that by now I've converted most of you to the gospel of measured moves, because look at how precise it is. Okay, there was a gap down on the open. So whenever you see a gap down, it is a bear candle, right? It's a strong bear candle. Market closed here, open down here, so that's pretty strong. So at that, you got to say, my goodness, look at the strength of that breakout. If we get continuation of that, then the bears want to get to a measured move. Boom, they get to the measured move. The reason that we have these tails in the market turning here is that it's two things. The bears are taking profits. They have achieved their minimum objective, which is a measured move. Okay, so if we are up and you are trading this, so this is, I'm still sleeping here, and I don't dream much, but I'm still sleeping. So if you are up and you'd seen that gap down and hadn't found an opportunity to take a trade, you should have taken that trade and put your stop at the 50% level, even at the beginning of that, hoping to get to a measured move. If you haven't gotten that and you see that kind of candle, you can take that trade. There's less profits taken, less profits left for you to take, but still a legitimate trade. Now, what you do when you see this, kind of price action, you really got to be cautious in taking your trade. If you do that, there is a measured move. You cannot ignore the measured move. There is also the high of February 2022, which is a key level of support. So the bears have to break beneath that, slight bit of follow through. So you must take your profits there. So the move is complete. Now, when I've seen that, for me, that was a measured move to get to there. We call it a final flag, final pullback, likely to have a bit more. So if you're in a trade, either take your profits here if you're going away, or if you want to just sit and watch, like I prefer doing, final flag, final pullback, you expect to get your measured move, you can take your profits or you can tighten your loss and see what happens. Then after that, that becomes a key low. Why is that a key low again for us? Well, everything I'm explaining, but also if you have a quick look at it, we now have the market trying to break through a level 3 times. We got to here, failed, got to here, failed. There's a third push. That is a wedge pattern. Absolutely perfect one. And we just want to see if we get a double bottom and get a higher low, and we take the trade. Okay, if the bears come back and accelerate beneath it, we look for measured moves, etc. Okay, so what I'm going to do, just to answer that question, Richard, let's look at this. So that low, okay, because of the wedge, well, let's use the high. Okay, so the market came off this wedge, went back, tested the open, the close of yesterday, and then the bears tried to resume it. Now, this was the first test here. This was the first test there. Then the bulls tried to resume it. This is enough, low test, etc. Tried to resume it. They got to test again the low of yesterday, and the market turned again. Now, what I'm saying is, don't count that as 1 and that is 2, and then say, okay, now at the third lower, I'm going to take a trade, because the market hasn't fully formed the top yet. That's where you got to count your 6 candles. And if it's within that 6 candles, just count that top as 1, because in my thinking, it's the same forces that are still at play. So the same forces that caused the bull candle at some point. So the market closed here, opened. At some point, it sold off. The bears sold off. Then the bulls came into the market and tried to test that and failed. And hence we had this doji candle. It's the same forces that are still at play with this inside candle, with this low test, and then the bulls trying to accelerate. It's the same forces that are creating this because they're still within 6 candles. So that first top, you can call that 1, 2, 3, 4, 5, 6. So all of these candles represent one combination of forces. So it's one top. Then if market had carried on 1, 2, 3, 4, 5, and came back and tested again, that becomes our second top. Then we just look for the lower high and we trade. All right, guys. So I'm going to leave that. Let me just quickly put up a few other charts so you can see. There's a number in 1 there. Okay, so 2 is within this kind of complex here. But we didn't get a nice, decent enough lower high. So you can't trade the middle of a trading range. This is Bitcoin. We have to wait. Gold. So there is 1. Now, why is that 1? Because it's a reversal that is closest to the level of resistance, if you want. So you could have, at some point, you could have said, okay, that's my 1, all these 6 candles. Then the market turns and goes up, but you got a tight trading range here. So if you mark your tight trading range, okay, everything that's within that tight trading range really is still the same kind of price. Overlapping candles, attempt to break about failed. We're back within the trading range. Then we have a few candle separations. So you could look at that and say all of that price action is really the market trying to top up there and failed. So you could do that. Wait for a few candle separation and mark that and say, okay, that could be my 2. And then you wait to see if you get a 3rd candle down. You didn't get that 3rd candle down. Now, the reason I didn't do that is because you really don't have to worry about doing that because of the tight trading range. I said to myself, I really need to see price separating out of that tight trading range for me to be certain that that particular top is going to hold. So that's why I didn't have my 2 there. I had the 1. There is an attempt to break above the tight trading range, failed. We came again to that level, and then the market started taking down. So that should hold technically because of the overlapping price action. What else didn't we look at? We look at Nikkei 225. Okay, we just did that. Euro. All right. I think we have looked at everything. All right, guys. So the point was this S&P 500. Okay, so there is a key low that becomes a 2, and let's wait and see what we get. So the point of this was just to share with you some insights in terms of how you can start to find trades. And I really think if you just work hard and trying to count these patterns, things become clearer and you become a lot more confident. Try and take trades on that 3rd price action. And if you just take 1 a day, you make good returns, and that's fantastic. All right, guys, thank you for all your comments. Thank you for those who didn't say anything because I know you're hearing me. Thank you, Richard, for questions. Much appreciated. And thank you, Mai, in the office. We will catch up with you guys next week. Enjoy.